Do you want to make money in stocks? Then don't buy stocks. It sounds like a contradiction? Well, it is, but it's also true. And in this video, I'm going to explain how you can make money in stocks without buying individual stocks. Now, this channel is all about helping you increase your financial intelligence, helping you gain the ability to invest with confidence and build your wealth. If that appeals to you, go ahead and subscribe now so you can gain the skills you need to kickstart your wealth building today. Now, back to the subject at hand. You want to make money in stocks? First step, don't buy stocks. Don't buy individual stocks. Looking back, it's easy to say, I wish I had bought Amazon or Apple early on, but you can't pick winning stocks based on hindsight alone. Let's say that you had in fact purchased both Apple and Amazon early on, before 2000. Then along comes the dot-com crash. Apple saw a massive drop of 51.89% in a single day. Specifically, September 29th, 2000. Oh, and Amazon? Amazon lost more than 90% of its value in 2 years. 90%? Most investors couldn't hold on in the face of such losses and gave up on the stocks. Few had the foresight back then to know what these two companies would become in just 2 decades. And therein lies the problem with trying to pin stocks down without a strategy. We don't know. Pure and simple, we don't know. Putting your money on any one single company is a gamble. And gambling is a risk-on roll of the dice, not a strategy. You wouldn't sit down at a chessboard and just start moving random pieces hoping to beat your opponent. You would sit down and develop a strategy for winning, and then implement that strategy. The point here is that instead of embracing individual stocks and companies you hope will go up, you should embrace a strategy of investing that allows you to invest with confidence, not living in fear that your individual stock pick is going to drop 40% in a single day. Now, strategies can be simple, they can be complex, and everything in between. Here's an example of a simple strategy. In fact, this is one favored by none other than Warren Buffett. Yes, the Warren Buffett. The strategy is this. Buy a mutual fund or ETF that tracks the S&P 500. That's the index made up of the 500 largest publicly traded companies in the United States. And then hold that fund for, 50 years. Yes, that's the strategy. That's the one advocated by Warren Buffett. Now, why is this a strategy? Because the S&P 500 actually adapts over time to changing market conditions. The component companies that make up the index are selected by a committee within the firm that operates the index. The committee can and will remove a company if it isn't doing well, goes bankrupt, or no longer represents the market. And then they'll replace that company with another that's doing better or is more representative. Every year, a couple of dozen companies are swapped out. To give you an idea of how this changes the complexion of the index, consider that in 1980, the top 3 companies in the index were IBM, AT&T, and Exxon. Today, the top 3 companies are Apple, Microsoft, and Amazon. If you held nothing but a single fund that tracked the S&P 500 since its inception, your portfolio has kept up with the times, ditching losers and embracing winners year in and year out. And all of this happening behind the scenes while you work, play, sleep, and get on with your life. Really, it's quite a beautiful strategy. There is just one problem. The S&P 500 is only made up of equities, that is, companies, or risk-on assets. And companies, large and small, are subject to the shifting tides that move economies. Many, if not most companies, see their fortunes rise and fall with economic cycles. On the long term, that's a good thing, because economies are expanding. But on the short term, there can be pain. A prime example is the 2008 housing and financial crisis leading to the Great Recession. Now, this is a chart for the year 2008, comparing a money market fund, basically cash, to the S&P 500 index in the form of the ETF SPY, or SPY. The backtest in green is our money market fund. The S&P 500, or SPY, is blue. The S&P 500, made up of 500 companies, crashed and burned, down over 40% at the low. If your entire portfolio was comprised of a single fund tracking the S&P 500, could you have held on during this crash? Would you have had the foresight to know that recovery was only months away? A lot of folks couldn't do it. They bailed at some point during the crash and then failed to get back into the market for years, missing the recovery and then some. What can we do to make it easier to ride out these kind of corrections in the equity markets? What can we do to make it easier to stay in the market, stay invested, and stay ready for the inevitable recovery when it does come? Well, one idea would be to swap out a portion of our equities for an asset class that would be a safer bet during times of market turmoil. Now, bonds fit that bill. And a good bond fund to use for this example would be AGG, an aggregate fund that holds a diverse basket of bonds, from US Treasuries to corporate bonds, municipal bonds, and others. So, let's make room in our hypothetical portfolio for a 40% stake in the bond fund AGG. As you can see, we've added a bit of complexity to our strategy by dividing the portfolio into 60% equities and 40% bonds. As before, our equities are represented by the ETF SPY, which tracks the S&P 500, and our bonds are represented by AGG. So how would our newfangled strategy have fared for the year 2008? Well, let's go to the chart. The green line, marked backtest, is our 60-40 combination strategy. The blue line is SPY, our proxy for the S&P 500. Now, as you can see, our strategy smoothed out the volatility, reduced the drawdown, and ended the 2-year period with less of a loss than if we had held SPY alone. Now, would that less of a loss be enough to keep some folks in the game and poised for the coming recovery? Perhaps so, and therein lies the benefit of this newfangled strategy. Of course, like all good things in life, there's a price to pay for reducing our risk during bear markets like the Great Recession. Taking a long view, say from 2008 to 2020, we can see that our new strategy underperformed a portfolio holding nothing but the S&P 500. Again, the green line is our 60-40 strategy, and the blue line is SPY. So for reduced volatility and smaller drawdowns during market corrections, we give up some returns over the long run relative to the S&P 500. This is a good example of the challenge investors face in juggling risk versus reward. By the way, we could shrink the portion of bonds in our new strategy and expect higher returns, but also higher volatility. Conversely, we could increase the percentage of bonds in our new strategy and expect lower returns, but less risk overall. So these are just two examples of strategies that are widely popular with investors, mainly because they're simple to understand and easy to implement. Strategies can go up in complexity from there. Now, personally, the strategy that I've implemented in my own account is the 12% solution. It takes the foundation that we laid in our previous example, that being a portfolio made up of 60% equities and 40% bonds, but then rotates monthly among funds within each of those asset classes. This allows us to play the concept of momentum, selecting the fund that offers the best chance of outperforming the others, at least for the upcoming month. The strategy also employs a cash trigger, getting us out of the equity component entirely during severe market corrections. And here's why I like the strategy. Let's take that same time frame we looked at earlier, 2008 to 2020. We're comparing the 12% solution, the green line, to simply holding a portfolio of 100% SPY, the blue line. You can see that the 12% solution not only reduces volatility and lessens the drawdowns, but also ended the 13 years quite a bit ahead of SPY in terms of total returns. Now, if you're interested in the details, it's all spelled out in the book by the same name. In the description below, you'll find a link to the 12% solution on Amazon. So, if you want to make money in stocks, don't buy stocks. Instead, buy into a strategy. Find one that makes sense to you, one that's easy to follow, and one that lets you live your life while it works on your behalf. Hey, thanks for watching, and don't forget to subscribe to my channel for more videos on the 12% solution, personal finance, and of course our ultimate goal, financial freedom.